everyone, and welcome to the second in IMAP's three-piece series on zero rates, what they mean for managed accounts. This is session 2. We have another session on Friday after our first session on Monday. So today we're taking a deep dive into the fixed interest asset category. We have Michael Karagianis, who will be moderating again today, and we have 2 fixed interest specialists to take us through the issues at play in fixed interest. We've got Michael Frearson from Real Asset Management and Jesse Imer from Mason Stevens. Michael's going to allow them to introduce themselves, so I won't steal his thunder. I just wanted to draw your attention to Friday as well. We look at other strategies to achieve traditional fixed interest goals. That'll be at lunchtime on Friday. As always, we'll be seeking feedback at the end of this session, and in particular, we want to know other subjects that you want to hear about. We might not get to all of your subjects, but this forms the basis of how we come up with ideas for future webinars and for our conferences as well. By the way, we're having a conference this year in February, and we will be sending out information on that soon. So without further ado, over to you, Michael.
Thank you, Amanda. And I guess one thing to point out at the outset is that there is the functionality to ask a question as we go. So I do encourage the participants tuning into this session to just click on the bar at the bottom. That question will only be seen by ourselves, and we will try and address all of them as we go through this presentation. Really looking forward to this presentation. For those of you who tuned in on Monday, we really gave a bit of a helicopter view, I guess, as to the issues associated with the defensive sleeve of a portfolio. What do zero interest rates mean for building an investment portfolio, and in particular, how do you go about structuring a defensive portfolio? And I think the conclusion that the panelists came to was that, yes, it does present challenges. Traditionally, fixed income has provided, I guess, a go-to for solving a number of problems within a portfolio. It has provided income. It's provided a diversification benefit against your key risk being equity duration, equity beta risk. And it's also provided liquidity. And in the current environment where interest rates have gravitated towards zero, that's started to break down. So now we have to be a little bit more discretionary about building the defensive portfolio. We have to perhaps look at fixed income in a more nuanced way. And really that's the purpose of today's conversation, to have a little bit more of a drill down into that fixed income component of a defensive portfolio and really ask the question, can it do the same role as it has in the past? Joining me are 2 experts, Jesse Imer, who is a fixed income strategist at Mason Stevens. He's been there since June of last year, had 11 years financial experience, has been experienced in advising clients across councils, superannuation funds, government agencies, fund managers. So welcome, Jesse. Also joining me, Michael Frearson from Real Asset Management, over 20 years experience in Australian investment markets, 15 of which have been as a portfolio manager in Australian fixed income and hybrid securities. Prior to joining Real Asset Management, Michael was a senior portfolio manager for Macquarie Bank, and particularly focusing on discretionary managed accounts. So I think we've got 2 very good panelists here to really give us a bit more of a deep dive into the fixed income sector. So really, perhaps asking each of them in turn to give us 2 or 3 minutes to introduce themselves, introduce their thoughts on this topic, and then we'll delve into some Q&A on this topic. And as I said, as we go along, please don't feel at all reticent about forwarding your own questions. Jesse, can I ask you to perhaps spend a little bit of time discussing fixed income?
Brilliant. Thank you, Michael. Thank you for that, such a nice introduction, and thank you for having me today. Mason Stevens, for those who aren't aware of our business, it's not quite like any other investments business in Australia. The most people that know us, we have a sophisticated investment platform, and it meets the needs of quite a lot of investors across Australia, basically to provide broad spectrum access to or investment solutions. But the thing that makes us different is a bit about our asset management services. That's something that I work for. It's a real point of difference. We manage more than $1 billion on behalf of investors in fixed income and credit debt solutions. We sit on investment committees of dealer groups across the country, and provide counsel to people who are looking to know more about fixed income, income opportunities, defensive allocations, etc., various mandates. So if you don't mind, if we could bring up slide 7. From our point of view, in terms of portfolio construction and defensive allocations on the asset management side, where they provide access, transparency, expertise. So something that we client advisors, such as that will be on the call, can align the right product with clients' needs. So in practice, that means we provide access to direct bond securities, to OTC or listed bonds or fixed income on a stock exchange as well, in multiple currencies too. But we also provide access to IMA and SMA solutions, something that we're so happy to present here with Imer today, because I know you share some of the proponing of managed account solutions, where clients are able to retain beneficial ownership of securities, but also have full visibility of holdings, so they can better construct multi-asset portfolios. I bring this up because without visibility or transparency, similar to what you might have an ETF or a managed fund, where it can be a black box of sorts, or you're not too sure of the overall currency overlay, the moving parts, etc. An SMA or an IMA is the most transparent vehicle for that. You do sometimes lose some diversification benefits. SMAs tend to be slightly more concentrated portfolios. But generally speaking, they're such a good vehicle that allows that transparency, that allows people, especially in uncertain times like right now during COVID impact and a few other things that are going on in the world, it just provides people that access and an ability to look at fixed income in a different way and really manage their money in a better way, I think.
Okay, Jesse, thank you very much for that introduction. I'll throw to Michael now, and perhaps Michael, if you want to share some initial thoughts.
Sure, thanks a lot, Michael, and thanks to everyone for joining us to talk about our fixed income. So just a brief overview of Real Asset Management. So Real Asset Management is a wholesale investment management firm. We've got around 1 billion in assets under management, in funds under management, and around 1.6 billion in assets under management, which includes a loan portfolio. So we've got around 500 million of fixed income, 500 million of direct property assets focusing on generating reliable income for investors also. So on the fixed income side, we have a number of wholesale funds. We also have a number of managed accounts, both in Australian dollars and US dollars for clients. So we're on a number of retail wealth management platforms. Moving on to the slide potentially of the current opportunities in fixed interest. We'll just talk very briefly about the current universe of securities. I can't currently see the slide now, but it's a brief overview of our investment philosophy. So with our investment philosophy, and given my 15 odd years background in managed accounts, just back one slide, please, Toby. We're an active manager of SMAs, and as Jesse highlighted, they're a concentrated portfolio, just given the size limitations you face in a direct portfolio. So we have a focus on quality and a focus on diversification. So the universe for our portfolio is effectively ASX listed instruments such as Australian hybrid capital, and we look to blend that with other higher quality fixed income solutions via ETFs or managed funds to provide some flight to safety benefits to the portfolio and helps manage the drawdown risk to the portfolio. So our main focus is generating reliable income for investors. The other quick point is about this chart is, as we know, it's why we're here, the yields have fallen to incredibly low levels at the short end of the yield curve, which we'll get into all the details for that shortly. So that's resulted in a few problems for the traditional approach to portfolio construction, given that you don't really get any return after fees and taxation for holding, risk-free and highly liquid assets like cash and government bonds. So we'll get onto the details shortly. Thanks, Michael.
Okay, thank you, Michael. Well, let's get into it, really, and I guess the topic of the conversation is zero interest rates and the impact on defensive portfolio construction and fixed income. So fundamentally, I guess we should ask, are zero interest rates here to stay? I'd be interested in your opinion on this. Obviously, it goes to the question of the outlook for inflation versus deflation. the impact of central bank policy, both in terms of the setting of interest rates, but also in terms of more recently quantitative easing and bond buying programs and so on. So basically special programs that central banks have introduced in this unusual environment. So perhaps, Jesse, if you wanted to kick off on this and give your view as to the outlook, and then I'll throw to Michael for his perspective.
Great, thanks, Michael. I suppose the first thing we start off with is our outlook for the world, because interest rates are largely driven by macroeconomic factors that affect generally the world, but then Australia is a small participant in the overall world market. So we're heavily influenced by exogenous factors such as US interest rates, European interest rates, even Asia Pacific interest rates to an extent. So the amount of inflation that we can forecast is a function of other economic activities, demand for Aussie goods, the Australian dollar, the influences of the Australian dollar, which a lot has to do with trade. So we believe that, or we forecast that inflation is going to be rather muted for an extended period of time. Now, we use a literary device such as the 3Ds to explain this. You have a large amount of debt, which means there's limited capacity for corporate, household, government balance sheets to expand using credit out of the 2020 into 2021, etc. And this and there's also, so the second D is also demographics. We're all very aware of a large cohort of workers who are slowly retiring in the baby boomer generation, and there isn't a corresponding pickup in aggregate demand through the younger generations, such as the millennials, for example. And then lastly, there's also the deflationary factors of scale of globalization and technological innovation that have created a large deflationary or disinflationary impulse over the last decade or two. So all this combined really creates an outlook where there's going to be lower for longer interest rate policy, something we see where the RBA is going to be very hard to increase the cash rate any year soon. And likely as Australian government has also stepped up during this time to assist Australians during COVID and the amount of people that have been out of work, what they've had to do is become a larger participant in the overall economy. And so as they are a larger part of the overall economy and they've had to issue debt capital, borrowing from the future in order to do so, that's reinforced this lower for interest rate policy, because if our current expansion or our rebound out of COVID is reinforced by debt, then it's going to take a long time to digest the debt, pay it off down, or meaningfully reduce costs, etc. So all in all, we just see a much lower for longer interest rate environment, and that just sets the scene that core government bonds, where they're yielding right now, there is an asymmetric return, to be sure. They in Australian context, they can't go too much lower, but it also means that we have to rethink about the income. So coming back to your points as well, we talked about fixed income being a diversification tool, an income tool, but also a source of liquidity. The source of liquidity and diversification short's still there. Just the income might not be there anymore, which is making us think about other options for income. And that's when we can talk about subordinated debt hybrids example, and even international fixed income later in the webinar.
I think it's over to me now, Michael, isn't it? So similar to Jesse, as everyone who follows fixed income markets, we're firmly of the view that rates will be lower for longer also. Like globally, there's been a huge amount of monetary policy support to bond markets. We've seen that with negative rates in Europe over recent years, and that's not just current. We've also seen a lot of support for the bond markets in Australian markets, also with the RBA cutting the cash rate to all-time lows. The bank bill swap rates in Australia are trading at 2 basis points. They've got their bond buying program, which is going to keep that short end of the yield curve anchored quite low. The longer term end of the bond market's more influenced by the global factors and also the outlook for growth. So although in the short term we see the short end of the yield curve staying low, longer term we're seeing increasing risk that these currently long bond yields are not going to last forever, particularly in an environment where we've had a period of a global synchronized shock to the world. Growth has been slashed. We're now starting to see clear signs of a global synchronized economic recovery that's being fueled by massive amounts of fiscal support globally, In Australia, I think there's around $500 billion of fiscal support alone, and there's also ultra cheap monetary policy everywhere. So given the current forecast for world growth are for a large uptick in growth next year, and as you know, equity markets are at all-time highs, we're thinking that over the next 1 to 2 year view, the longer end of the bond market could sell off slightly, but it is still going to be low by historical standards.
Well, Michael, I rejoined just in the nick of time, it seems there. So I'm assuming that you gave an adequate answer. I do apologise. I'm going to go out and try and get an alternative to the. So thank you both for that feedback. I mean, obviously, you know, it seems as though zero interest rates are not a transitory thing. We're going to basically be dealing with it for quite some period of time. So it does go to the question of portfolio construction. Jesse, you know, coming back to you, I guess fixed income, as I said earlier, is been traditionally a source of liquidity, income, diversification. At a very high level, how do we go about building a portfolio? You know, and obviously we can talk in more nuanced detail about the tiers of credit and so on as we go through this presentation. But really, you know, from a broad perspective, what do we have to change in terms of our mindset? Clearly, we've gone through a period over the course of the last year where you know, fixed income portfolios have been adversely affected by equity markets. We haven't had the defensiveness that people expected from that sleeve. You go back to the post-GFC period, similar problem emerged. Has something changed? Are we looking at you know, maybe needing to change the definition of defensive, or do we need to change the way we address fixed income in portfolios to satisfy that definition? What are your thoughts?
Thanks, Michael. I'll answer this in two parts. And if Toby or Amanda, if you could bring up slide 9, please. I just want to make sure everyone's aware when we talk about fixed income as well, and we say that it, you know, it might not have been quite as defensive as we wanted this year, but overall fixed income returns are driven by two factors. There can be changes in the credit spreads, i.e. the amount of premium I receive from lending to a Westpac compared to the government, that above the risk-free rate, but also the changes in interest rates, which are generally measured by the risk-free rate, which is government bonds. Now, we measured both of these through a sensitivity called duration, interest rate duration, credit duration. But these are the two primary returns of bonds. And so into the future as well, we know where risk-free rates are. So that's why credit becomes the larger factor of what people are looking for to get that incremental return. You know, when we used to receive 5% from government bonds, now that was happy days because we had all those elements of diversification and liquidity as well as income. But that income's no longer there. So I believe you can firmly only choose two anymore, where you have to have a trade-off between income, diversification, and liquidity, where you can only choose two of those. So a lot of investors are slowly migrating into, they want to keep the income, and two, then it becomes how much liquidity, how much diversification. And so just thinking, if we bring up my slide on price volatility, slide 10, please. Something that happened this year was where people lost a bit of faith in government bonds because they experienced a liquidity event. I want to make it abundantly clear that March, April, until central banks such as the Bank of England, the US Federal Reserve, even our RBA in late March, stepped in and helped the market, there was a deep liquidity event which affected all financial assets. It affects them differently though, and we will have to be aware of that. So what I'm showing you here is a Westpac hybrid in the red line, WBCPF, versus a Westpac senior bond. So still a senior bond, a corporate bond being Westpac debt, AA rated, AA minus rated, but the Westpac hybrid sold off 12% and then it recuperated most of the 6% or so to come back. Whereas the Westpac senior bond only dropped just over %, rallied all the way back and now sitting at an all-time high, about 2% above that. So we can see how the different defensiveness of these allocations has paid off. So senior bonds is much different return profile or defensive profile compared to a hybrid profile. So coming back to your question about portfolio construction, we just need to be aware of all these different parts in here. So some clients, it's in their interest to be more defensive and less about the yields, which we would suggest more portfolios that are less about income but more about diversification and liquidity. Whereas other clients that might be more growth orientated or more balanced or growth, they probably can have a larger trade-off towards the income and less towards the diversification of liquidity. But we just need to be aware of that.
Michael, your thoughts?
Yeah, similar to Jesse, I guess, in that, I mean, at the higher level, has fixed income become less defensive? In the context of, the spectrum of asset allocations available, no, it certainly has not. Fixed income remains the same. What's changed is the yields are currently low, so the diversification benefits from holding long duration assets are slightly less than they have been historically. So that is important for portfolio construction. But does this change the way that we manage portfolios at Real Asset Management? Short answer is no, it does not. We're a firm believer in diversification. You need to have exposure to both high quality assets and some higher yielding, more subordinated assets in the portfolio. So what has probably changed, or it's been magnified by the low yield environment, is that the returns available from both active management, by having a high quality manager with a process that screens the investments, and also the returns from the credit spread have become increasingly important drivers of return. So the chart that Jesse had earlier certainly highlights that, and that's where there's a chart on slide 18 we could maybe bring up also, which just really illustrates how that has changed over time, to put it in some historical context. This chart here just highlights that this is the spreads available. The bottom chart shows the spreads available on ASX listed hybrid securities as a percentage of the total expected return at time of issue. So we go back to pre-2007, the actual percentage of return from the credit spread was relatively low. It was around 15% prior to the GFC, given base rates were so high. If we roll forward to currently, where there's been the major bank issuing at 3.4 to 3.5% above the base rate, and that's actually 34 or 35 times higher than the current cash rate. So as a result of that, all the return is driven by credit spread. That's why you need to have a strong focus on active management and understanding the quality and the risk to each of the investments in your portfolio.
Yeah, and Michael, I guess, and Jesse, I guess this goes to my point that has the nature of fixed income changed? I think ostensibly you could say no, that the same sort of building blocks are available. Government bonds are being issued in increasing volumes at this point in time. We obviously have quite a wide spectrum of credit opportunities, ranging from senior debt through to subordinated through to hybrid type securities. So there's a feast of opportunity there that can be incorporated within portfolios. I guess what has changed, and I'd be interested in your thoughts on this, and this is where people probably have been disappointed by the performance of the asset class, is in response to the collapse in the underlying risk-free rate, so cash rates, the drop in the spectrum of government debt across the yield curve. Investors have responded by going further out on the credit spectrum. So they've increased the component of credit within their portfolios to enhance yield. They perhaps decreased the credit quality to enhance yields even further. And hence you've started to pick up some differential performance in the way those portfolios start to behave that maybe is catching people out. I just wanted to get your thoughts on that. I guess that, when we build portfolios, people have traditionally lumped fixed income in together within a defensive component within a portfolio. And my view is, and I'd be interested in your thoughts, that is, overly simplistic. And we are into a situation now that we have to be very wary about, this credit phenomena and the potential for it to, at certain points of an investment cycle, turn around and bite us. Jesse, perhaps if you wanted to lead off on that one.
Thank you. If you may, I'll love to introduce slide 8, where I want to talk about capital structure then, because exactly what you just said, Michael, we've caught people out this year because maybe they didn't fully understand exactly what they were invested in, all the different components of their return. And so I've already mentioned, that bonds generally have two different types of return. From credit premium, government bonds don't have credit premium, but they also have the interest rate return, or the interest rate risk, interest rate duration, etc. So, but things to be aware of is the capital structure. So when we look at a corporate bond, for example, and if we look at the left-hand side, I use NAB as an example, you've got covered bonds and then you're down to equity. And this is what you could call as a capital structure or a capital stack. What it is, it's just a priority of debt. The higher up having higher priority, the lower down having less priority, with equity ranking behind all the debt obligations. And with that becomes more sensitivity towards equity risk. So what caught people out this year, coming back to your question, was that the subordinated debts, some of the lower tier subordinated debts, and then the hybrid debt in the blue, and we call it additional tier 1 capital or hybrid debt, these were incredibly sensitive to equities and caught a few people out this year. And so I showed that with my chart before, showing the difference of what happened to a Westpac senior bond versus a Westpac hybrid. Thank you. Yeah, it just goes to show the difference of volatility, but there's also a different return. So if we might look at slide 11 now, please. I wanted to show a snapshot of the current market. And so this shows Westpac senior bonds, what they're yielding. They're much lower risk profile, but much lower return profile. Subordinated debt in the blue in the kind of middle of the chart. Higher return profile and than the senior debt, though below the hybrids in the red. So we just need to be aware of exactly what we're invested in. So coming back to my introductory comments where I talk about, how an SMA is such a nice tool to view all that, is because you can literally see how much subordinated debt do I have, how much hybrid debt to have, how much senior debt do I have. And government debt's all senior debt, and it's backed by the usually treasuries of the states or the government that issues it. But it's all senior debt as well, and hence why it has a much different risk return profile to equities. So bringing this all back to, we have different opportunity sets here depending on different client alignments. And so we just have to be aware on what we're investing in here.
Michael, your thoughts?
Yeah, sure. I guess just to add to that, at the high level, the main thing that changes is advisors and clients need to lower their return expectations. If we just look at a traditional balanced portfolio structure, you may have 30% in traditional bonds, 5% in cash. That 35% of the portfolio, which used to have a yield of 4 or 5%, is now only yielding around 0.7% combined, if you're lucky. So after fees and after taxation, it is hard to achieve returns. But if you move away from that structure, you're obviously taking on increasing risks for the portfolios. So it's more about educating clients that the defensive part of the portfolio is going to not yield much in the current environment, but we need to keep it that way so it remains defensive. Otherwise, they're moving up the risk curve. So that's probably the first point. And then the second point, as we know, for all the same reasons, that trade-off between income generation, capital stability, and income has certainly increased. It's been magnified by the record low base rates. So if they do want to invest in some higher earning securities, they need to be aware that comes with volatility. Potentially it's less liquid, but there's certainly a strong case for having a component of that in portfolios. Just got to make sure it's at the right level for the right client.
Yeah, and just on that point, we've had a question come in, which I think really goes to the heart of it. I think it's quite a useful question to pose. Are we accepting that trade-off now is more apparent between return that you can get out of fixed income and the risk associated with it, or potentially even the illiquidity associated with it? So it's much more of a distinct trade-off perhaps than we've faced in the past. Are we actually getting enough return for the potential risk out there? So clearly we've had a collapse in interest rates across the board, a compression of credit spreads. They've recompressed post-COVID. But are we back into a situation where really people aren't getting enough return for the potential default risk associated with some of these investments? I'd be interested in your thoughts. Michael, do you want to kick off on this one this time?
Well, it really depends, I guess, on what investment you're talking about. So each investment different. That's why I'd come back to the first point I made, that having an active research process is incredibly important when selecting from credit securities, given the asymmetric risk profile. So if you're investing in unlisted private debt or in like mezzanine loans, which have been quite popular lately, people think, wow, I can get 10% return in this mezz debt property fund. That's great when cash is 0.1. Well, that's fine until that issuer may default and you lose a big component or all of your capital. So you really just need to be diversified across the portfolio structure. If you go back to the hybrid spreads, as Jesse highlighted, they're still well above historically low levels in credit spreads. And the bank quality in Australia is actually increasing, not decreasing, even during our first recession in 29 years. So the bank capital levels are strong and rising. All the hybrid securities are still paying income streams, unlike the equity. So I would suggest that they do currently offer attractive risk-adjusted value. Senior credit spreads have compressed to all-time lows. Major bank credit spreads are around 30, 40 basis points above the 2-month bank bill swap, the 2 basis point bank bill swap rate. So you're only going to get 30 or 40 basis point return for that senior credit risk. And sub debt, you're only going to get 1.7% or so above that. At the senior end, I do agree that after fees and everything, there's not a strong case for taking on that additional risk. However, it is still going to deliver above cash returns in a normal market scenario.
Okay. We've had a question come in, and I guess this is always going to come up in fixed income conversations. Definition of duration and I guess credit duration. Jesse, you mentioned those terms, so I think it's beholden on you to give us a very quick 2-second view as to what they actually mean and the significance of them.
So interest rate duration is a measure of the sensitivity to changes in market interest rates. So if we're looking at a bond, and we measure this in a couple of different ways, there's different terms you'll hear about it moved about, such as modified duration, regular duration, etc. What we're really doing is measuring a weighted average cash flow, and when you're receiving back, how much sensitivity you have to a bond. So you might see a Westpac, I keep using Westpac as my example. Westpac issues a 5-year bond. It might have an interest rate duration just under 5 years, it might be 4.5 years, for example. Whereas their credit duration, its sensitivity to interest rates would be measured, as a basis point spread, it would be about 5 years, because it's going to be sensitive to credit for pretty much the entire 5 years, but its interest rate duration might be slightly less. And this changes based on how high or low interest rates are, and especially how long the investment is, because a longer investment will generally have more interest rate duration. Funnily enough, though, and something we really need to be aware of, is that Australia is a very large market for floating rate notes, which have very low interest rate durations because they reset quarterly, or in some cases semi-annually, but mostly quarterly, which limits the interest rate duration. It also limits the overall sensitivity to market interest rates, because if you had a 10-year fixed rate bond, you're sensitive to interest rates for most of that 10 years. Whereas if you have a floating rate note, you're only sensitive to the next 3 months until it resets. So in this case, there would be very low interest rate duration, but the same credit duration. So just being aware that this is a measure of sensitivity to changes in interest rates and changes into credit premiums.
Yep. And I think, for simplicity purposes, the way I think of interest rate duration is just sensitivity of the investment to changes in interest rates, either up or down, and the impact that has on the capital value of the bond. So the longer the duration is, the more capital sensitivity you have. The shorter duration is, particularly with Jesse talking about floating rate notes, the less sensitivity to volatility. And that's an interesting point, because in an environment where you have very low interest rates, one of the risks that we have in the bond market, and I'll be interested in your own views of this, is at some stage in the future, do bonds themselves actually represent a capital risk? If we actually started to see from very low levels a rise in the yield curve, perhaps as a consequence of central banks stopping their bond buying purchases, or perhaps as a consequence of inflation actually rising, is it a potentially a scenario, because of that duration effect, that we could get a loss out of what is ostensibly the defensive part of the portfolio? What are your thoughts on that, Michael?
Sure. Yeah, I'll try to cover that off. I'll just also add another important point about duration risk also. So obviously, as rates have come down globally over the last 10 years, there's been a period of above average return from bonds, because as Michael and Jesse highlighted, as interest rates go down, bond prices go up. So as rates rise, the reverse is potentially going to be true. We may be going through a period of below average returns from fixed rate bonds. But another important point to note with duration is like the return on any investment comes from two sources. One source is the movement in capital value, and that's where duration moves around the capital value as interest rate rise. If you hold it to maturity, you still get the $100 back. But the other important source of returns is the income stream on the security. So each bond has a terms of issue which pay periodic coupons to investors. So if you're holding a bond for a 12-month view, although if rates go up slightly, you may lose 1% on capital, you may actually pick up 2.5% on yield. So net, you're still going to make a positive return. So it's important to remember that part of the returns from the income, and given that's part of the key reason why people buy fixed income also. Back to your other point, I guess, globally, there is a slide I had maybe on slide 16, which does sort of illustrate the potential risks. And certainly, as we were all in agreement earlier, I think rates are lower for longer. It's no danger in the immediate term. Central banks are keeping rates low. But longer term, if we look out to next year, once vaccines are successfully rolled out, there's been some very promising data announced and the comments made about potential vaccines being rolled out in the new year globally. If there is a synchronized global recovery, the longer end of that yield curve does have room to move higher. It's not going to go back to where bond yields were 4 or 5 years ago, but it could easily move from 80 basis points towards 1.5% or 2%, which would create a bit of a different investment opportunity set for investors at that point in time.
Okay, well, look, let's spend the last section of the webinar today really talking about how to build a portfolio for fixed income in this environment. I guess taking on some of the thoughts and discussion about the credit tiers that we've already gone through, the duration issues, and so on. So, Jesse, maybe if you wanted to lead us off, given your perspective at the present time, how would you go about building a fixed income portfolio that I guess tries to tick as many boxes in that income, liquidity, diversification spaces as possible?
Thanks. So yeah, it's changed a lot over these years, and so how we're articulating this through an investment thesis right now with the Mason Stevens Retail SMA or the Mason Stevens Credit Fund, but also when we're counselling various of our 1 billion plus of mandates that are sitting on our platform, is that we're building portfolios that have income objectives. End of the day, there is always an objective of the portfolio, and in most cases, this has some kind of income objective. In a lot of cases, it's something like RBA plus 2% or CPI plus 2%. So first and foremost, we have to build a universe of securities that fit that brief. If that brief can't be met, then obviously we need to change the objective higher or lower depending. And some investors are lowering the objective because they don't want to take the extra incremental risk to try and achieve that old objective of X% return. So we're building portfolios where we can screen out a lot of the investments that aren't going to fit there. Over a 3 to 5 year holding period, we're getting rid of our short-term views on what capital price appreciation might do, and we're buying bonds that have a certain stability and defensive characteristics. So as a house as well, we're very defensive right now. We like Australian bonds because of the overweight exposure to financials and how entrenched their market position is in the Australian economy and the defensive capabilities of that industry sector as a subcomponent of the overall bond market. Likewise, we also like public-private partnerships, PPPs, where you might have a Civic Nexus bond, for example. That's the old Southern Cross Station, Royal Women's Hospital, for example. These are ventures that have backing, implicit backing from our state governments that pay that income into them, which then pay our bond coupons. They're still very defensive. So we've lowered our return objectives slightly, and this is across clients, but also across our internal mandates, but we're still keeping that defensive capability. And so then the other parts, so once we've covered off the income, is all about the diversification point of view. So we're slightly adding more securities. The Mason Stevens Credit Fund has more securities than ever, just to try and keep that diversification benefit across industry subsectors, but also across capital status. So achieving that income, but then diversifying as much as possible within that. Same with our SMAs. Now, SMAs, we already mentioned, they're a slightly more concentrated vehicle, but wherever we can, we're trying to create that diversification across industry and across capital. And then lastly as well, it's liquidity. So we screen out the smaller bond deals. So there's certain bond issues where they might only issue $200 million. We tend to avoid those because they don't have secondary market liquidity. So if an event happens and we want to sell and we're not able to, then it's not defensive asset anymore. So for us, we screen out a lot of these investments. So we're only targeting a very niche amount of bonds anymore.
And Michael, your perspective, I guess also, importantly, what can be invested in from a managed account structure as well. Some strategies are more amenable to managed accounts than others.
Yeah, thanks, Michael. Maybe if we can go back to slide 14, where I have some of the opportunities set with managed accounts. So obviously, with like managed accounts, as we all know, they're an incredibly efficient way for firms to manage their clients' portfolios with lots of time saving and compliance benefits. I guess the main limitation with managed accounts is both the concentrated nature of them, given they're directly held, but also the investment universe that the particular managed account provider will allow the managed account to invest in. So generally, you're limited to ASX listed securities. And obviously, there's a huge and growing range of ETFs, which can provide significant diversification benefits and low-cost access to, different sources of beta. There's also generally the large wholesale fund menus, which you can access through the managed account providers. And like also, so then it really comes down is to, would you like direct exposure via some hybrids? You have to be cognizant that they're higher risk, potentially more volatile, and higher income. Or if you want traditional fixed income exposure for diversification purposes, you need to access that for either an ETF or a wholesale fund. So in the chart here illustrates the main different yields available on the different subsectors. And in our strategies at RAM, we blend the portfolio and actively manage the portfolio amongst those subsectors to deliver on that income return for our clients.
And I guess both of you have made some interesting points about the way you construct portfolios. We've had a couple of questions come in, which I think pose different sides of the potential story moving forward. One, taking the view, is this an environment where, trading activity or perhaps active management more generally will play a more important role, trying to add alpha to the beta story effectively? Or is this an environment where, really interest rates are so low that we should question why we're paying away fees for active management at all, and maybe we should focus on ETF type approaches? Do you want to give pros and cons to that, Jesse, in the time remaining? Perhaps maybe a 30-second type response.
Okay, absolutely fantastic question. And it requires a much longer answer. In really short, though, we believe that you have to be more active in the future. Something that it's happened literally 60 out of the last 120 years. I wrote a note about this on Monday, that they're called lost decades. They're periods where stock markets and even bond markets have returned 0% in a buy and hold strategy. And we believe that this next 10 years is going to be one of those kind of periods of time. So we really believe that you have to be more active. However, that doesn't mean that you can't be active using ETF approaches. So ETF approaches are generally lower cost. We all know this. And they are generally passive, but there are some active ETFs. Definitely incorporate those where they espouse your certain clients' objectives and views, where appropriate, as a reduction or mitigant of fees. But at the end of the day, you just have to be active or actively aware of what you're investing within.
Michael, your view on this active versus passive?
Yeah, well, that relies on we're an active investment manager, so we certainly have the view that active is better than passive. But as we know, like, we do use some of those ETFs for our managed account strategies, just because they're good building blocks to get subsector exposure in the portfolios. So I guess, like, with each investment, you just need to be aware, like, what are you actually buying? Like, if you buy a bank bond cash ETF, what do you get currently? And like, you get like 10 basis points. If you buy a composite bond ETF, what's the yield to maturity? It's around 60 basis points. If you buy a higher sub-debt type yield to maturity, what's available on that? So you just need to make sure that whichever investment you choose, that you understand how it's likely to behave and what the investment characteristics of that are.
And certainly from JANA's perspective, we've always been, and certainly in the current environment, been a little bit more cautious about bond ETFs as opposed to perhaps ETFs in other asset classes. Largely because the structure of the ETF is often based around the level of issuance. So the more issuance out there by a particular issuer, the bigger the representation in the ETF. And that's not necessarily the way you want to build a portfolio in this environment. It certainly can add diversification, and that is a great benefit. But I guess one of the things we do look for in the current environment is more active management to contribute to performance, and that, I think, is a theme that both of you have picked up on. We do, I think, also question whether the fees that active management is charging at the moment in fixed income is sustainable, given the underlying collapse in the level of returns. So those fees are becoming a significant component of the overall return that I think at some stage people will begin to take more notice of. We've got time for one more area of conversation before we sign off, and that is the obvious question: international diversification versus Australian only. Now, Jesse, you talked about a direct model where you really focus on looking at opportunities in the market locally, building portfolios, SMAs or whatever, but effectively keeping that universe relatively smaller than a managed fund approach. Is that a reasonable approach when you want to take into account international bonds? Is there a benefit of having international bonds in a portfolio in this environment?
Thank you. Yep, I definitely think the answer is yes, there is a benefit to having international bonds, but then we have to talk about currency. So if we can bring up slide 12, please, international fixed income. It all comes down to the goals of the investor. So, and the degree of risk and return that they're willing to take. Traditional international fixed income uses currency hedging, as the currency cross rates generally gyrate more than the fixed income asset price. We saw that this year where our Aussie versus US exchange rate capitulated down to 55 cents in March. Now it's back up around 73.5 before this call. It's had a 20% swing, whereas bond prices haven't had that much swing. So if you weren't hedged, you saw quite a large movement in your bond price's capital value when we repatriate it into that Aussie terms. Doesn't mean there's not opportunities, though, especially in the hedge sense. So in this chart that I'm showing you, I'm just using Aussie major banks because there's 143 different bonds just in Aussie dollars, euros, and US dollars in this chart. So it's more than enough to make my point. The Aussie bonds, the senior yellow ones are all in a very tight spread. They're just above 0% as Michael's already iterated. And you've got some of the subordinated debt slightly higher in the 2s to 2.5%, nearly 3% for one of them is range. The Euro bonds are generally much lower yields. They have a negative yield curve. ECB's deposit rate is at minus 50 bips. And generally Aussie bonds, when they're issued in euros, some of them have negative yields. So there's less opportunities in euros, but there's certainly some opportunities in dollars, there's some opportunities in pound sterling, as well as CNY, New Zealand dollars, etc. So for people that have access through an SMA structure, ETFs, managed funds, there's definitely opportunities in international fixed income. US market, particularly investment grade space, plenty of yield still, especially for the longer term investors. And as well in their US dollar high yield space, something that you can take selective or tactical exposures for, where US dollar high yield has obviously a high yield, it's in the name, but with more risk, so hence an appropriate amount consummate with a client's needs, and generally currency hedged. Though I will also note that if someone did have the view that they thought the US dollar was going to outperform the Aussie dollar, they could buy US dollar bonds as a comparable to Aussie dollar bonds, and then take that currency view, they're espousing a currency view there, but at the same time, they're buying US dollar bonds with a similar income otherwise. So there's lots of opportunities, just depends on the risk profile.
And Michael, to finish off, I guess your view on international fixed income, and perhaps within that context, the potential benefits of cross-currency positioning that active management could bring to an international fixed income portfolio.
Yeah, thanks, Michael. I'll probably have to defer to someone who specialises in the cross-currency alpha generation, because it's not a strategy that we employ here at RAM. But back to the initial high-level question, yeah, certainly as part of a diversified portfolio, having international fixed income still makes a lot of sense for portfolios. You can get a higher yield in the US markets, as Jesse highlighted. I think the things we've talked about at the outlook for Australia are relevant globally also. Given that it's been a global synchronized slowdown, the vaccines are rolling out globally, it's going to be a similar economic recovery also. So in that environment, I still think having been an overweight position in investment grade floating rate credit, and also for the right clients, having some higher yield credit in portfolio makes sense as the recovery takes shape.
Okay, well, look, gentlemen, thank you very much for your thoughts today.